Hello and welcome to the Upside Capture podcast. I'm your host, David Stubbs, Chief Investment Strategist of Alpha Core Wealth Advisory. Today I'm joined by Tom Cole, co-founder of Distillate Capital, a value-focused asset manager based in Chicago. Now, Tom has an impressive CV. He was a CIO of Institutional Capital and head of US equities at UBS Global Asset Management. We're going to be talking about all things about today's equity market and where to invest. Now, before we begin, please remember, folks, that nothing in this podcast is investment, tax, or legal advice. Myself or Tom may or may not have positions in some of the assets discussed, and always, always, always do your own research. Without further ado, Tom, welcome to Upside Capture.
Yeah, thanks, David. It's a pleasure to be here.
Now, Tom, let's start off with a wide lens. Let's talk about expectations for US equity returns. Now, at the end of last year, all the big banks came out with their annual update of their capital market assumptions. I know that you and the team do a lot of work in-house about where valuation is pointing us today. Run us through your methodology and what it says to you, what we can expect from US equities.
It's an interesting time. Let's start there. History would tell you, based on valuations, that we are in a place where expectations going forward need to be turned down from where returns have been realized, at least in the last several years. When you go back and look at returns by their components over a long period of time, what you see is that growth in fundamentals, and we tend to prefer looking at free cash flow. But if you look at the growth of free cash flow and the growth of dividends over a really long period of time, what you see is that that is the primary driver of returns. That improvements in valuations or the multiples that people are willing to pay for stocks ebbs and flows. And we've been through one of those periods where people have been willing to pay more for equities. In just the time that we have had since we launched our strategy in 2017, the market's compounded, or at least the S&P 500 has compounded at almost a 15% rate since then. But fully a third of that has come from multiple expansion. And not just that valuations by themselves will tell you when that is going to end. And in fact, we know that valuation by itself is not a very good predictor of where returns will be a year from now. But when we've reached the levels that we've reached now, we can look out a decade or more and suggest that returns will be fairly low. And that is pretty consistent with a lot of the work that's coming from Wall Street. Now, we take a bit of a guarded approach when it comes to valuations that are presented to us like that. By contrast, most of Wall Street says, yes, valuations are very expensive, but we're going to remain bullish. And you saw that in the year-end reports when you look across, the various strategists that publish their work. Bloomberg does a really nice job of putting together a group of over 60 strategists, and their overall commentary on that was that they were universally bullish. So as much as Wall Street is very bullish, that's reflected in the multiples. We're actually kind of cautious from the standpoint of valuation.
Yeah, and just dig into a little bit about why you prefer free cash flow as your preferred valuation measure versus price to earnings, price to book. These are things that viewers would have heard quoted in the media.
It's an answer that's rooted in the change in our economy and the fact that you need to understand accounting rules to recognize what you're being offered in the marketplace. Assessing value when you roll the clocks back was a relatively simple exercise. And value investing became really popular over the course of a 30-year period because it transacted in a way that allowed you to beat the market. Value investing is something I think that appeals inherently at a very, basic level of of human beings because we're all essentially value shoppers all the time anyway. Whether you go and buy groceries or buy a shirt or buy a car, if you can figure out a way to pay less, it obviously intuitively only makes sense. When you apply that to the stock market, you're transacting in something that Warren Buffett made obviously very popular, the idea of buying cheap stocks. It gives you downside protection and allows you more upside potential. And for a long period of time, it was a relatively easy exercise to transact in. If you look at the top half of this slide, starting in 1960, all you really needed to do was to buy stocks that were trading at a low price to book multiple. And for the course of a 30-year period, since this chart goes from 1960 to 1990, by doing that, you outperformed the market by a material amount. This is a relative wealth chart. So you lay this result on top of the underlying growth in equities. And in fact, if you had the foresight to do it, you would have ended up being a fairly wealthy person, no matter what level of starting investment you had in 1960. But starting in 1990, that measure broke down. Price to book, or buying low price to book stocks, really stopped working. There certainly were periods, coming out of the internet bubble where it worked. But if you had followed it over the course of that 30-year period, you would now be behind the curve and have been much better off simply investing in an index fund. So what happened? Well, what happened was that our economy changed. We went from an economy that was pretty ubiquitously driven by traditional capital spending, building plant and equipment to do things like build cars and build typewriters and build telephone lines and extract oil from the ground, to an economy now that's much more driven by research and development. You can see that when you look at the leadership of the market in 1960 and compare that to the leadership now. I think you can certainly see it in the national income data, where the amount of money being spent on tangible capital has declined as a percentage of GDP, while intangible activity has picked up. And you see an even more extreme version of that when you look at public companies and recognize that as recently as the 1970s, research and development dollars were pennies on the dollar of capex, and that relationship is completely flipped over to the point now where research and development is a multiple of the underlying level spent on capital or traditional capital.
That's fascinating, Tom. What I'm hearing is we've had this big shift in the economy away from asset heavy to kind of asset light, away from tangible physical investment into the intangible, the intellectual property, the coding, the software, etc. And that actually has led to a change in how market investing works. It led to the breakdown of that relationship that you pointed out, which was so powerful from 1960 for several decades. So what does it look now, and how do we navigate this environment?
Yeah, and part of it, David, it's clear this is not an argument to spend more or that you need to pay more to own stocks. The issue is that you've just simply lost comparability because the accounting for these two activities is completely different. Research and development gets expensed as it's incurred, whereas capital goes on a balance sheet and slowly gets expensed over time. The way to restore comparability and truly identify the least expensive stocks in the marketplace is, rather than focus on the typical accounting metrics that we're all taught to use, so things like book value and earnings to calculate PEs, if instead you focus on free cash flow, which is a much better indicator of the underlying economic performance of the businesses, you can still isolate what is least expensive in the marketplace. And it turns out when you do that, that value investing, or paying the least for stocks in the marketplace, is kind of alive and well. To make it quick, I mean, if you look at this blue line in the bottom half of this slide, the curve here is replicating the same curve that we saw starting in 1960, going out to 1990. It didn't really stop working in 1990. What changed was the valuation measure that you must use to find the least expensive stocks in the marketplace. And that's the underlying thought process that's behind the firm that we started in 2017.
That's fascinating. So ultimately, value isn't dead. Value just changed its spots to a certain degree, and focusing away from price to book, more traditional, to free cash flow, has unlocked actual, significant outperformance if you invest by quintile, as you showed on the previous slide.
That's right. There are certainly are times, and we're in one of them now, where free cash flows and stock prices become delinked. This chart goes back to 1985, which is when free cash flow data first became available. And what you see over time is that stock prices in the blue line, and free cash flows in the red, tend to trend with one another pretty well. But occasionally something comes up that causes them to disconnect, and it's usually a function of market multiples and investor sentiment. The first time the disconnect was, in the TMT bubble in the late 90s and early 2000, and obviously stock prices got well ahead of the underlying fundamentals and then corrected. And then we had this opportunity coming out of the great financial crisis in 08, '09, when, the market mentality was kind of get me out at any price. And they left a lot of good companies available to be purchased at sort of record-breaking levels in terms of their level of being inexpensive. And now, obviously, we've moved forward to a point where stock prices have risen well in excess of the underlying free cash flow generation that they produce, which has gotten us to a point where, if your alternative is simply to buy a cap weighted market index like the S&P 500, you need to be concerned about valuation, sort of back to my initial comments when we first began.
When you look at across the market right now, where do you see the opportunity to deploy capital? Are there particular sectors which, on your framework, look a little bit better than the overall market?
Yeah, we're very agnostic about sectors. We have no favorites. When we do the work that we do to calculate valuation, we do need to take the accounting statements and make a group of adjustments to account for things like option issuance that don't fully get reflected in the FA, the Financial Accounting Board standards results. But when you do that and apply it equivalently across all the market, um, we end up, kind of gravitating toward places typically that haven't participated in the market in terms of the appreciation that we've seen. So at the moment, we're finding good valuations in healthcare, in some sectors of industrials, despite the fact that the S&P 500 has re-rated, to a meaningful degree. And in fact, if you look at this chart, free cash flow yield. So we actually think about it in the context of a yield. So free cash flow versus stock prices. Coming out of the great financial crisis back, now quite a few years ago, 8, oh, 09, and 10, equities were really quite inexpensive, and were a good entry point. Now we've completely re-rated to a point where the only time we've seen free cash flow yields on the S&P 500 more expensive than they are right now was during the last innings of the TMT bubble in the late 90s and early 2000s. But despite that, with selectivity, there are good values below the surface. The free cash flow yield on our strategy is actually equivalent to where it was in 2017 when we started, and we've driven returns at almost the same level of the S&P over that period of time. So it's not a bad starting point in terms of the underlying group of stocks that you choose from. It just that we happen not to own any of the leadership. Likewise, the international markets are more attractive than certainly the S&P 500. That wasn't always the case. When you look at the red line here, the free cash flow yield going back a decade ago was actually more expensive than it was outside the United States, or it was more expensive outside the United States than was the S&P 500. A lot of people were making the case that you needed to diversify internationally because it was cheaper. But in fact, it was not when you look at things on a free cash flow basis. And in the meantime, the growth rate in the United States has been better. The businesses, by and large, are less levered, and they have a higher degree of stability. So you don't really need to create a story about U.S. exceptionalism, although there certainly are cases where the U.S. has been meaningfully more productive and innovative than outside the U.S. to create, a story that makes total sense of why the S&P has outperformed international markets. But at this point, the international market is less expensive, and there again, with selectivity, you can do much better than that. And then small caps are an interesting story. If you want me to go on, David, I mean the small cap benchmarks themselves. This happens to be the Russell 2000 in terms of the free cash flow yield. are typically more expensive than the S&P 500 if you don't exclude the money losing businesses. A lot of times you hear people make a bullish case about small caps, and too often they're doing that by looking at PE ratios where they simply take the money losing businesses out of the equation, which obviously flatters the small cap benchmark. But almost 20% of that benchmark now is in a money losing position. And so you need to be very careful in avoiding some of the junk that's some of the zombies that are in that benchmark. Yeah, the benchmark to us is a fairly treacherous place in that there are a lot of zombies and there are a lot of debt. But again, with selectivity, there's great opportunity within that benchmark to find a group of stocks that are trading at much more attractive levels without the debt and with higher levels of underlying fundamental stability.
Interesting, really interesting, Tom. So what I got from that is, despite the decline in the free cash flow yield that you're showing there in blue in the US, there are still some companies which are attractive on that measure. I also got that, as we know, small caps can sometimes appear attractive, but there's a lot of companies in there that maybe not the highest quality, and of course the international opportunity in red there. The other thing when I look at this chart is, if you just go back 10 years, interest rates around the world were basically zero, and you had, on a relative basis, here at Alpha Core, we obviously put together multi-asset portfolios for clients. On a relative basis, equities were really striking value, 10 years ago. But today, with short-term fixed income, you can get, obviously high 3%. You've got the 10-year yield around 4.25, and that drawdown in the blue line there, to into the threes, also shows on a relative basis that the market today does look fairly expensive.
Yeah, and we're not multi-asset managers, we're equity managers, but we've made that same observation over time that certainly there are alternatives out there that look more attractive than they were certainly a while ago. Our portfolios not only concentrate on stocks that are less expensive, but we also layer into that a quality and in fact, quality variable. And in fact, we actually start with quality, with very much the mindset that you need to protect your client's capital in order to generate good long-term returns. So we look for underlying fundamental stability, and we tend to stay away from businesses that are over levered. And that's not that we don't like debt on a company's balance sheet, but we don't want too much of it, so that we always have a group of companies that will be around to live for another day, or live through the unforeseen, whether that's a downturn in the economy or something like a global pandemic. So rates have been an interesting ride since we started the business in 2017. But we found that we sort of generate returns no matter the underlying environment, because the portfolio is pretty dynamic and willing to move around a fair amount to where there is opportunity in the marketplace.
So, Tom, obviously, a lot of people talking about the valuation levels today versus where they were in the dot-com era in the late 90s, early 2000s. There's a transformational technology in play. We've seen tremendous market performance, a lot of hype. When you look at those two periods, how do they compare, and where do you find the value today, given the position markets find themselves in?
Yeah, we're not finding much valuation opportunity in the leadership. We're not inherently AI skeptics, but there are a lot of similarities to the way things were going in 2000, and there are a lot of similarities to prior periods when there was a significant technological change in the marketplace. Whether you go back to the railroads or autos or radio, very typically stock prices get well ahead of the underlying fundamentals, and very typically, investment overreaches existing capacity. Um, who knows where we are in that equation right now? The numbers are getting tossed about are enormous, obviously, and we'll see how that all plays through. But when you look purely at the underlying fundamentals and valuations, there are a lot of similarities between now and 2000. If you look at the bottom of the slide, the gray bars are where things were in 2000, and the blue bars are the free cash flow yields currently. And similarly to where things were 25 years ago, the largest stocks in the market are the most expensive. They were yielding 1.1% at that time, and they're yielding 1.7 as of year end. So certainly things at that time were more expensive than they are now. They had dragged down the overall yield on the S&P 500 to 2.2%, and they're at 2.7 now. But interestingly, as you look at various indices or different stocks in terms of their sizes across the marketplace, what you'd see is that less expensive stocks were available in the market. If you look at the smallest 200 stocks, at that time, 25 years ago, their yield was, 4 or 5x what the underlying level of the leadership was. And similarly, they are less expensive now. And then with selectivity, we can generate a much more attractive portfolio than that. But what's really interesting, I think, is that, 2 years later, which is what is addressed in the top half of this slide, 2 years later, when the market finally kind of found its bottom, that group of 10 biggest stocks 25 years ago was down around 40%. That's what this slide is showing. They had dragged the S&P 500 down 28%. But when you look across, the equal weighted benchmark was actually up, and the smallest 200 stocks in the S&P were up something like 45% over that 2-year period. So the market differentiated fairly quickly when things changed, and we're not suggesting that history will exactly repeat, but certainly the precedent is there that people will gravitate back toward valuation, and that market prices and the fundamentals will, in fact, at some point in time, come back together in some form.
Yeah, I think that's one lesson of investing is that you can have a dislocation between price and fundamentals for a while. It can go on for quite a long time as well and be quite frustrating, but eventually the fundamentals do reassert themselves. And I think that there's an interesting conversation to be had about structuring equities in this environment. I think the equal rate index there is a really interesting one. It's a question we get from clients a lot about whether equal rate positioning can play a role, and as you say, with selectivity, you can really get a much more attractive entry point in an actively manageable portfolio.
The market repeats in certain instances, and one thing that it always does, and that is that if it looks for an attribute and forgets the price that it's paying for that attribute, it typically doesn't end very well. It can go on for a fairly long period of time in terms of that disconnect, but it always does come back together. And the price you pay always matters. Valuation ultimately, at the end of the day, always matters to the ultimate returns that are earned.
Exactly, as one of my favorite investors, John Gray, once said, is that your entry price is forever. Your financing costs may change, for example, other things may change, but your entry price is forever. Okay, Tom, I think we'll leave it there. Thank you so much for your time today and your insights on equity investing. Folks, I hope you enjoyed that. If you did, consider subscribing to the Upside Capture podcast, wherever you get your podcasts. Also, make sure you check out the insights from Tom and his team at distillatecapital.com. And while you're at it, swing by alphacore.com as well. Until next time, look on the upside. This podcast is being provided for informational purposes only and does not constitute an offer or solicitation and should not be considered tax, legal, or accounting advice. The information represents the current views and opinions of speakers as of the date of this podcast, and there is no guarantee that any opinions will prove to be accurate or any forecast made will come to pass. No obligation is undertaken to update any information, data, or material contained herein. This communication is not recommending the purchase, sale, or hold of any security. This presentation and the information contained herein may not be reproduced, in whole or in part, in any format, without AlphaCore's express prior written consent. Certain information contained herein has been obtained from published and non-published sources prepared by third parties. While such information is believed to be reliable, AlphaCore does not assume any responsibility for the accuracy or completeness of the information, which is based on matters as they exist as of the date of this podcast and not as of any future date. Before embarking on any investment program, you should carefully consider the risks and the suitability of a strategy based on your own investment objectives and financial position.